Hello guys, welcome to iTutor Academy. In today's session, we will start with the 11.6 overhead variances. MMBZ 004. The term overhead includes indirect material, indirect labor, and indirect expenses. Overhead may relate to factory, office, or selling and distribution departments. However, for the purpose of variance analysis, we can broadly divide the overhead cost variance into two categories as shown below. Overhead cost variance OCV, that is divided into variable overhead cost variance and fixed overhead cost variance. Each of these variances is discussed below. Overhead cost variance, it is the difference between the standard overhead for actual output and actual overheads. It is the total of both fixed and variable overhead variance. Overhead cost variance is equal to recovered overhead minus actual overheads. Variable overhead cost variance VOCV, it is the difference between standard variable overheads for actual output or recovered variable overheads and actual variable overheads. VOCV, that is variable overhead cost variance, is equal to recovered variable overhead minus actual variable overheads. Causes of variance. This variance may be due to advance payment of expenses or outstanding expenses, or payment of past outstanding expenses during this period, or on account of certain abnormal expenses incurred, such as repairs of machinery due to breakdown, expenses due to spoilage or defective workmanship, or excessive overtime work, etc. Fixed overhead cost variance, it is the difference between standard fixed overhead for actual output and actual fixed overhead. And cause of variance, difference between actual and recovered. Fixed overhead may be on account a higher or lower amount of fixed overheads compared to budgeted. Fixed overhead might have been incurred for the same production during the same period. The same amount of fixed overheads might have been incurred for a high or lower production than the budgeted production during the same period. And computation of overhead variance illustration is here. You just go through it and try to analyze this. It will help you for your term and examination, and activity also based on that. You just do it that. And classification of fixed overhead variance. Fixed overhead variance may be classified as shown in the following chart, that is fixed overhead expenditure variable variance and fixed overhead volume variance. Fixed overhead expenditure or budget or controllable variance, this variance is due to the difference between budgeted fixed overheads and the actual fixed overheads incurred, and budgeted fixed overhead minus actual fixed overhead. Fixed overhead volume variance, this variance arises because of the differences between standard and actual output, resulting in under and over recovery of fixed overheads. It is therefore the differences between overheads absorbed on actual output and those on budgeted output. And here is an illustration section also, activity section also. You just go through it. Sales variances. Sales are affected by two factors, that is selling price and the quantum of sales. The variations in the standard set and actual for the purpose may be mainly due to change in marketed trend, and usually if the selling price increases, the volume of sales will be lower than the standard. It may result in a favorable variances as to price or unfavorable variance as to quantity. It is to be borne in mind that higher price here is to be viewed as a favorable, and lower volume of sales is to be viewed as a unfavorable. And it is well known that the demand and supply position in the market decided the quantity of sales and the selling price. The variation may be on account of control lab as well as non-controllable factors. Change in the market condition and demand by customers are of course beyond the control of management. However, certain factors like high price are controllable, and effort should be made to check adverse variations due to these factors. Sales variances can be understood with the help of the following chart. Sales value variance is divided into sales price variance and sales volume variance. Sales value variance, the difference between budget sale and and actual sale result in sale value variance. Formula is sales value variance is equal to budgeted sale minus actual sales. If actual sales are more than the budgeted sales, a favorable variance would reported and vice versa. The difference in value may be on account of a difference in price or volume of sale, which is therefore analyzed further. And sales price variance, it can be calculated like a material price variance. It is on account of the difference in actual selling price and the standard selling price for actual quantity of sales. The formula is actual quantity sold into standard price minus actual price. Price variance is equal to standard sales minus actual sales. Sales volume variance, it can be calculated like a material usage variance. Budgeted sales may be different from standard sales. In other words, budgeted quantity of sales at the standard price may vary from the actual quantity of sales at the standard prices. Thus, the variance is a result of difference in budgeted and actual quantities of goods sold. The formula is standard price into budgeted quantity minus actual quantity. Volume variance is equal to budgeted sale minus standard sales. If the standard sales are more than the budgeted sale, it would cause favorable variance and vice versa. So computation of sale variance is here. You just go through it, and verification also here. Sales value variance is equal to sales price variance plus sales volume variances, and budgeted sales equal to budgeted price into budgeted quantity. Okay, so just remember this equation. It will help you for your answer writing. And control of variances. After the variance have been computed and analyzed, the next logical step for the management is to trace the responsibility for the variance to particular individual or department. The management or cost accountant may be required to prepare a necessary report for this purpose. The report submitted to the management should clearly indicate where action is required. Based on this report, the management will try to identify the specific individual for adverse controllable variance which being with their control could have been avoided. It was earlier mentioned that certain factors such as changes in market condition, demand and supply position, etc. are beyond the control of managers. Hence, action to pinpoint the responsibility of such an uncontrollable variance is not called for. And in case of controllable variance, the responsibility could be traced as shown below to the different department for different variances, and variances and department to be held responsible. And it may be noted that the variance analysis would not help in achieving the desired objective of minimizing cost unless managerial action is prompt and in the right direction. And the next is variance reporting. As stated above, the deviation along with their causes should be reported to the management regularly and that at the opportune time so that corrective action may be taken immediately. The person or department may be held responsible for any adverse variation after duly accounting for it, and the information about the profit earned by the business is presented through a simple profit and loss account where a system of historical costing is prevalent. However, when a system of standard costing is in operation, the information about the standard, the actual and the variance along with their causes should be depicted through a statement so that the management may be able to take quick action in respect of any inefficiencies thus revealed. The statement draws a reconciliation between the budgeted profit or standard profit and actual profit. The preparation of this statement can be understood with the help of the following. And illustration sections are here. You just go through it, and here is 2 pages and 3 pages are there. Activity also based on that. Activity 1, 2 and 11.6 is here. So try to answer this. It will help you for your term and examination. And summary of this chapter is the profitability of a business enterprise depend on basically on 2 factors, cost and sales. The effort of the management should be minimize the cost without compromising on the quality and pushing up the sales of the product. This requires proper monitoring of both cost and sales performance. Targeted have to be fixed and the actual result should be compared with the predetermined target and variance found out. and the variance report have to be submitted to the management from time to time. These report contain detail regarding the budgeted standard performance, actual performance, the quantum of variance, and the department or executive responsible for adverse variances. And here is exhibit 10.1, a diagrammatic representation of variance and their interrelationship. So you just go through this diagram, it will more clear. And the keywords are from this chapter. If you feel any keywords are difficult, you just refer this section. And self-assessment questions also here. What is a variance? Why are the variance computed? How can the variance be controlled? And list some possible causes separately for material price variance and material usage variance. And what is direct labor efficiency, that is time variance? What is the managers or supervisors can or should to do to ensure that there is no such a unfavorable variance? And distinguish between variable overhead cost variance and fixed overhead cost variance. Why are such variance caused? Discuss the importance of variance analysis in operational and management control. How does this technique you help in what is popularly known as management by exception? And seventh question also here, fill in the blank question is here. And here is from the following particulars compute the direct material variances. So this is from the discussed portions. You just try to calculate all this. Maybe questions will expect from this side also, calculation side. So answers of the activity also here, so you just refer that. In between you feel any difficulty or doubts, you just contact us, and we will help you for and sort out the doubt. Okay. And for more MBA Ignou videos, you just do share and like, subscribe our channel and support us. Thank you so much.
i-tutor ES presents Ignou MBA complete syllabus coverage classes and individual semester base subject coverage program for MBA students, online and flexible sessions. For more details, contact 62382 17885.